The pain almost never arrives when most people think it does. It does not begin the morning when a market headline finally turns dark. It does not begin when television anchors start using words like crisis or contagion. And it does not begin when ordinary investors feel the first sharp drop in their account and suddenly decide that something is wrong. By then, something has usually been wrong for a while. That is the difference between the way financial pain is experienced and the way it is built. For the public, pain feels sudden. For sophisticated capital, it usually looks gradual. Not because smart money can see the future with perfect clarity, but because it watches parts of the system that ordinary investors rarely notice until those hidden changes become personal. That is the real question here. Not what smart money buys, not what it sells, not which ticker it prefers or which sector it avoids. The more important question is what it notices first. Because long before the public feels the pain, the conditions that produce that pain are already moving, and they usually move in silence. The first thing smart money notices is when strength starts depending on more effort than it used to. That sounds abstract until you look closely. In healthy periods, confidence does not need to be constantly defended. Credit flows with relative ease. Markets may wobble, but they recover without extraordinary intervention. Companies can raise capital without too much strain. Households can still refinance, still borrow, still plan with some confidence that tomorrow will feel roughly understandable. The system does not have to be perfect. It only has to be flexible. But as conditions begin to worsen beneath the surface, that flexibility changes before the public narrative does. On the surface, things can still look stable. Prices may still be high. Big companies may still look fine. Economic language may still sound reassuring, but underneath that surface, capital starts behaving differently. It becomes more selective, more cautious, less forgiving. And that is usually where smart money begins paying closer attention. Ordinary investors tend to focus on outcomes. Is the market up or down? Is inflation higher or lower? Did a central bank cut or raise? Did a company beat expectations? Those are visible facts, and they matter. But sophisticated capital tends to focus more on conditions. How easily is money moving? Who is still getting funded? What kind of risk is being rewarded, and what kind is quietly being avoided? Which parts of the system still work smoothly, and which parts now require more support than they used to? That distinction matters because outcomes are often late. Conditions are often early. A market can look healthy while the quality of that health is deteriorating. A country can still look financially credible while the cost of maintaining that credibility is rising. A portfolio can still feel safe while the assumptions supporting it are getting weaker. This is one of the oldest patterns in finance. Fragility rarely announces itself at the beginning. It hides inside normality. Smart money notices when money becomes more selective before the public notices that money has become more expensive. That is the first major shift. When systems are strong, capital is broadly available. Not reckless, not free, but available. Risk can be distributed. Mistakes can be absorbed. Weakness in one area does not immediately threaten confidence everywhere else. There is room for error, room for delay, room for policy, room for people to be wrong without being ruined quickly. When systems begin to harden, that room starts to disappear. Capital still moves, but not as widely. Credit still exists, but not with the same generosity. Funding becomes more conditional. Lenders become more selective. Investors begin demanding more compensation for uncertainty. And institutions that once looked relaxed begin behaving as though optionality matters more than upside. To the public, this often looks like nothing. Life goes on. The headlines do not yet sound alarming. The market can even keep climbing for a while, which makes the whole process harder to see. But beneath that apparent calm, a subtle sorting process begins. The strongest balance sheets still get trust. The cleanest stories still get capital. The safest borrowers still get time. Everyone else starts feeling less room, less patience, less forgiveness. That shift matters because financial pain rarely begins with everybody suffering at once. It begins with narrowing tolerance. Smart money watches are narrowing very closely. It notices when lenders stop being impressed by the same narratives that worked a year earlier. It notices when refinancing becomes more important than expansion. It notices when institutions start caring less about how much they can make and more about how fast they can exit. It notices when good enough is no longer good enough. That is not panic. It is not a prophecy. It is recognition. And that recognition often comes long before ordinary investors feel any pain at all. The second thing smart money notices is when time horizons start getting shorter. This is one of the most important changes in any financial cycle, and it is usually misunderstood. People assume that smart money is aggressive because it knows something dramatic is coming. Sometimes the opposite is true. Sophisticated capital is often cautious not because it expects immediate disaster, but because it can feel that uncertainty is no longer being paid properly. That changes behavior. When time horizons shorten, institutions become less interested in stories that require perfect conditions to work. They become less comfortable with assets that only make sense if liquidity remains abundant, confidence remains high, and policy remains supportive. They start valuing flexibility more. Not because they are sure something will break tomorrow, but because they know that when flexibility becomes scarce, it becomes expensive very quickly. Ordinary investors often miss this because they are still looking at price. If prices are holding up, it feels as though confidence is still intact. If the market is not collapsing, then how serious can the concern really be? But price is not the whole story. Sometimes the price is the mask. There are periods when prices rise even as resilience falls. That is what makes later pain feel unfair. The public sees a stable surface and assumes the foundation must be stable too. Smart money looks at the same surface and asks a different question. How much support does this now require? That question changes everything. Because once the system starts needing more support to produce the same calm, the calm itself becomes less trustworthy. The third thing smart money notices is when the story people are telling about the market stops matching the actual plumbing of the market. This is where finance becomes dangerous for ordinary people. Not when the facts are missing, but when the interpretation of the facts becomes too comfortable. Every cycle creates a popular explanation for why the current moment is safer, stronger, or more durable than it looks. Sometimes that explanation is partly true. Sometimes it is mostly narrative. But in either case, once the public falls in love with a simple story, it becomes harder to notice the contradictions building beneath it. Smart money spends less time asking whether the story sounds persuasive, and more time asking whether the system behaves as though that story is sustainable. If confidence is supposedly strong, why is capital becoming more selective? If the expansion is supposedly broad, why does the same narrow set of leaders carry so much of the optimism? If risks are supposedly contained, why are institutions suddenly paying so much attention to liquidity, refinancing, and optionality? If the outlook is truly stable, why does every shock seem to require so much reassurance? That is where the real difference appears. Ordinary investors often listen to story. Smart money listens for strain, and strain has a sound. It sounds like tighter terms, shorter duration, higher sensitivity to disappointment, less tolerance for leverage, more demand for certainty, more interest in cash flow, more concern about what happens if funding dries up, if buyers step back, if policy tools arrive late or arrive with side effects. None of this guarantees immediate pain. That is the part people get wrong. Early warning is not the same as immediate outcome. Smart money does not necessarily notice an exact event before the public. What it often notices first is that the system can no longer absorb shocks as easily as it could before. That is a deeper and more important idea, because once the system loses room for error, even small surprises start mattering more. This is where the story changes. Most people think smart money wins because it predicts the future better. In reality, its biggest advantage is often simpler than that. It is not always better at forecasting. It is better at recognizing when the cost of being wrong has gone up. That is the midpoint most ordinary investors miss. A flexible system can survive a lot. It can survive bad news, policy mistakes, weak quarters, sentiment swings, and temporary dislocations. It bends without breaking because there is room inside it. Liquidity still exists. Trust still exists. Refinancing is still possible. Risk can still be transferred. A rigid system is different. It may look stable right up until the moment it doesn't, because rigidity can imitate strength for a while, but rigidity means there are fewer easy adjustments left, fewer painless rescues, fewer harmless delays, fewer mistakes that can be absorbed quietly, and smart money watches that loss of flexibility before the public experiences its consequences. It notices when policy choices become less clean. Trying to solve one problem makes another worse. When supporting growth risks reigniting price pressure. When restoring confidence risks weakening credibility. When defending stability begins to cost more than it used to. Ordinary investors usually enter the story later when those abstract tensions become personal. When borrowing feels harder, when hiring slows, when salaries lag, when housing affordability narrows, when the market no longer rewards patience the way people expected, when retirement assumptions feel less safe, when the same monthly life suddenly costs more emotional energy than it used to. That is the moment the public says the pain has arrived. But the architecture of that pain was built much earlier. It was built when institutions started prioritizing resilience over enthusiasm, when capital became choosier, when lenders became less forgiving, when policy became more constrained, when optimistic stories required heavier maintenance, when the visible surface stayed calm, but the hidden machinery beneath that calm became more fragile. This is why sophisticated investors often look unemotional at exactly the moments ordinary people feel most comforted. They're not always smarter in the dramatic sense. They are often just less hypnotized by the surface. They understand that markets do not simply reflect confidence. They also reflect the resources needed to maintain confidence. And when those resources start running thinner, the risk changes even if the mood is not caught up yet. The fourth thing smart money notices is behavior. Not public statements, not polished presentations, behavior. What are institutions actually doing? Are they expanding aggressively or quietly preserving flexibility? Are they reaching for maximum upside or protecting themselves against surprise? Are they behaving as though the future is wide open or as though they know room for error is shrinking? Behavior is often a better signal than language because language can remain optimistic long after behavior has become defensive. A system under pressure often sounds more confident than it really is. That is because confidence itself becomes part of the support structure. Reassurance has value. Stability has value. Narrative has value. But those things only work for so long if the underlying conditions keep deteriorating. Smart money pays attention to that divergence. It notices when private caution grows inside public confidence, when people still talk about opportunity but structure their decisions around durability, when they still participate but do so with tighter risk controls, when they still hold exposure but care much more about what can be converted, refinanced, defended, or exited. To ordinary investors, this looks inconsistent. If the outlook is good, why so much caution? If the outlook is bad, why not full retreat? But that misunderstanding comes from thinking in binaries. Up or down, bullish or bearish, safe or dangerous. Smart money often thinks differently. It asks not whether conditions are perfect or broken, but whether the distribution of outcomes has become less forgiving. That is a more mature question and a more uncomfortable one, because it means the real shift often begins before the average person has any emotional reason to believe a shift has started. The fifth thing smart money notices is when pain moves closer to ordinary life, even if markets still seem detached from it. This is the final bridge, and it matters most. Financial stress does not stay in the financial system forever. Eventually, it travels. It travels through jobs, lending, small business confidence, real estate turnover, wage growth, budget pressure, delayed purchases, postponed risk-taking, and a general feeling that the future requires more caution than it used to. But ordinary people experience these things separately. A tighter loan, a missed promotion, a weaker contract pipeline, a more expensive renewal, a delayed move, a smaller raise, a portfolio that looks stable but feels less useful. Each of them seems isolated. Smart money sees them as connected. It understands that by the time the public experiences pain as a collection of personal problems, those problems are often the social translation of earlier financial tightening. The system changed first. Daily life interpreted it later. And that is why the smartest capital is rarely obsessed with drama. It is obsessed with sequence. What comes first? What follows next? What weakens quietly before it breaks visibly? What gets harder before it gets scary? What loses flexibility before it loses confidence? What requires more support before it demands outright rescue? That sequence is the real advantage. Not because it guarantees perfect decisions. It does not. Not because it eliminates uncertainty. It cannot. But because it gives sophisticated capital time to reduce exposure, time to build resilience, time to widen optionality, time to stop treating calm as proof of safety. And time is the one advantage ordinary investors usually realize they need only after it is gone. So what does smart money notice before ordinary investors feel the pain? It notices when money becomes more selective. It notices when time horizons shrink. It notices when the story stops matching the plumbing. It notices when policy options lose simplicity. It notices when behavior turns defensive before language does. And above all, it notices when a system that still looks stable has quietly become less able to absorb stress. That is the real answer, not a secret asset, not a magic trade, not a dramatic prediction, a change in resilience. That is what the public usually misses. People imagine pain as an event. Smart money often recognizes it first as a loss of room to borrow, room to refinance, room to rescue, room to be wrong, room to wait, room to assume tomorrow will be generous just because yesterday was. And once that room begins to shrink, the future changes before the crowd feels it. The most important lesson, then, is not that ordinary investors should become paranoid. It is not that every calm period hides a disaster. And it is not that smart money is always right. It is that the surface of finance and the structure of finance are not the same thing. Prices can soothe you while conditions harden. Headlines can reassure you while flexibility narrows. Confidence can survive for a while even after resilience has started to weaken. And by the time pain becomes obvious enough for everyone to agree on it, the most valuable thing is usually no longer insight. It is time. That is why the people who move first so often look early, cautious. Even overly conservative until later makes their caution look less like fear and more like recognition. Because the real divide in markets is not always between optimists and pessimists. It is between those who watch what is visible and those who watch what is changing underneath it. And the hardest truth in finance may be this. When ordinary investors finally feel the pain, that pain often seems sudden only because the deeper story began in places they were never taught to watch.